When I invest my money in equities, I realize that equities is the best asset class for beating inflation and increasing purchasing power. The reason why equities offers these higher returns over traditional fixed income instruments is the fact that it comes with its own inherent fluctuations and volatility. So for the advantage that equity funds give you of earning higher returns than inflation, it also has these disadvantages of intermittent fluctuation. At any point in time, independent of whatever is the market view, equity as an asset class has three directions. It either goes up, it goes nowhere for long periods of time, or it comes down. So there are three outcomes in the near to medium term. But in the long term, equity has one direction and one outcome, which is trend upwards. So while the long-term trend is upwards, the intermediate trend can be any of these three. To an investor who's coming in for the first time in equity investing, I would urge you to be aware of this balance of the long-term trend of equities going up, but at the same time, intermediate trends of prices going down. Most investors think that I can only earn the upside of equity and give the downside to someone else. Actually, that happens only in theory. In the real world, you cannot get the upside of equity without going through periods of downside. Evidence and data says that broadly 60% of times equity markets trend upwards and 40% of times they go down. So it's very important. It's extremely important for us as investors to accept these 40% of times and prepare ourselves for it. Can you eliminate these 40% of times? The answer is no. Would we like to eliminate? Of course, yes. But it's the reality of the law of equity investing, which is to earn higher returns, you have to pay a price. And the price that we pay is short-term volatility. Now, most investors get afraid of this short-term volatility and they convert these temporary losses into real losses by getting out when the market starts shaking, by completely exiting the asset class when the news flow is negative, when the headlines are negative, when recent returns or last 2-3 year returns are negative. I would only urge you to look at history over last 30-40 years in India and history over the last 100 years across all markets in the world, where over a long period of time, significant wealth creation is done through equities. So it's very important for us as advisors, for us as investors to realize that staying invested for long term is the only way in which you can take advantage of the long-term potential of equity returns. But to get that long-term potential without the short-term downside is impossible, and hence to even expect that is futile. Then it's better you do not invest in equities. It's better you remain in fixed deposits. It's better that you do not compound your wealth if you cannot digest the ups and downs of equity. I think the message is very simple. To gain something, you have to give up something. To gain long-term advantage of compounding of equities, what you have to give up is the short-term comfort.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.